Hello everyone. In the previous video, we saw how to derive the SML equation. In this one, we are going to use some data to test it. Before we begin to work with the data, let us have a brief recap of what we wish to achieve through our exercise and how to do it in Excel. We already know the SML equation. This is that equation here. On the left hand side, we see the average excess returns on the security. And on the right hand side, we see beta of the security times the average excess return on the market. Well, this is similar to writing an equation for a straight line like this: y is equal to a plus bx. We can now map our terms and see which term corresponds to which one. Well, this ri bar minus rf maps to this y here. This beta of I maps to this b here, and rm bar minus rf bar maps to this x here. But there is nothing for this intercept item here, a. There is nothing in the SML equation that maps to this a here. This tells us that if we regress excess market returns on excess security returns, we should hope to get a zero intercept if the CAPM holds. Let us call this zero intercept a zero alpha rather. To do this quickly, we can use the linest function in Excel, which calculates the statistics for a line and returns the output in a 5x2 array like the one you're seeing here. What do we have in the array? What does the linest function report to us? It reports to us the slope here, b, the intercept, a, the standard errors of the slope and of the intercept, the coefficient of determination, r square, the standard error of the y estimate, the f statistic, the degrees of freedom, and the sum of squares for regression and for the residual. For testing the CAPM, we are interested only in the first two rows here, because we want the value of the intercept, which is in the first row, and we also want the standard error of the intercept, which is in the second row, second column. So the first two rows here from the linest function are of interest to us. This can be done by using the index function in combination with the linest function. Because the index function, you may or may not know this from before, returns to us a value from a table or a range. We don't want the whole table. We just want to pick up some values from this table, and the index function in Excel can help us to do that. So we are going to have to use a combination of the index and the linest functions. So when we work with the data, I will show that to you. Once we know the estimated intercept and its standard error, we can compute the t statistic to see the significance of our estimated intercept, which we are calling the alpha. You may or may not remember this from your statistics courses, that we are going to be working with the null hypothesis that alpha is equal to 0. And in order for us to reject the null hypothesis at a 5% level of significance, the t statistic should be at least 1.96. How do we compute the t statistic? This can be done very easily by subtracting the hypothesized value of our parameter from the estimated value. Well, the hypothesized value is that alpha is 0, and the estimated value we are going to get from the regression. So we are going to take a difference between those two values and then divide the difference by the standard error of our estimate, which we are also going to get through our linest function. If the value of the t-stat is below 1.96, then we are not going to be able to reject our null hypothesis that alpha is equal to 0. And in that case, the CAPM would hold true. Let us now look at the data. So let me go to the other sheet where I have the data. Well, this is where the data is. I had collected monthly data from January 2007 to December 2011 for 3 companies, and also for the market S&P 500. In order to have a little diversity and also use a little bit of motivation from pharma and French, one of the companies that I took here, Apple, is a large cap company. The second company here is the Spectra Energy Incorporation. This one is a medium cap company. And the third one here is the HealthSpring Incorporation. This is a small cap company. I also collected the monthly T-bill rates here from the Federal Reserve's website to serve as a proxy for the risk-free rate during this period. Now, though we cannot replicate the pharma and French results with such a small sample size and sampling period, it would still be interesting to see what results we get. We are essentially interested in looking at the mechanics of how to implement this whole thing. So let us start working with the data. What we want is first of all to have estimates of excess returns for Apple, Spectra, HealthSpring and Standard & Poor's. Let us begin therefore by naming some data ranges. We have also done this in a previous video, naming data ranges and working with them. So we have selected this range here where we have all our raw returns, and when I say raw returns I mean the returns from which the risk-free rate has not yet been subtracted. So this data range is going to be given a name. This name box is here, and into which I have already typed raw underscore RET. So this entire data range signifies our raw returns. And this data range here is my data range for the risk-free rate. So if I select this, you are going to see in the name box already that I have filled in a name for this data range, RF here. So this is my risk-free rate. Now I can very quickly and easily find the excess returns. So I highlight the area where I want my excess returns to go. So let me finish highlighting it. And keeping the selection active, I'm going to simply say here RAW underscore RET minus RF, and then hit Control Shift and Enter keys all at the same time to get the excess returns filled into this space. So we now have the estimates of expected returns for Apple, Spectra, HealthSpring and the Standard & Poor. So now we can begin to use our index and linest functions to find the alpha estimate. We are also going to find the standard error of the alpha estimate and the Tstat to see if alpha is significant enough or not. So let us write in index, start bracket, and then index function is asking us to provide an array where it should look for a particular row and column. And we know that our array is going to be estimated by the linest function. So we are going to have to invoke the linest function. So I'm writing here LINEST, linest, start bracket, and the linest function is going to ask for the Y range of my data and the X range of my data. I know that the Y range is going to be in this column Apple's excess returns. So I'm going to select that because this is my dependent variable. Alright. Then the linest function is also going to ask me for my X range, which is my independent variable, in this case the excess return on the market. So let me select that range here, comma. Then the linest function asks us if we want a value for a constant and do we also want the statistics associated with our line estimation. We are going to just leave these blank here, comma, and I'm going to write a 1 because I want the statistics to be reported. That was a little bit of tongue twister. So I've closed my linest function now, comma, and then I'm going to provide my index function the information about where to look for my desired value. Where is my alpha going to be in the array? It is going to be in the first row, second column. So I want to tell the index function, please look in the first row and the second column. And then I close the bracket and hit enter. And I get here my estimate for the alpha for Apple. Now I can use the same method to find the standard error for the alpha of Apple. So I'm going to invoke the index function once more. Let me do this quickly now. Linest, my Y range, my X range, comma, 1 because I want the stats, close bracket for the linest function, and I want to tell Excel now where is the standard error. It's going to be in row 2, column 2. So I'm telling the index function, please go and look in the second row and second column. Close brackets for the index function, hit enter. So this is our standard error for the alpha of Apple. We can find out the Tstat now pretty quickly. What is the Tstat going to be equal to? On the numerator, we are going to have a difference between the estimated value of alpha minus the hypothesized value of alpha. Well, the estimated value of alpha is this, and our hypothesized value is 0. So let me put this thing in a bracket and then divide the whole thing by the standard error of the estimate, which is this here. So we have a Tstat of 2.5422, and this immediately tells us that this alpha estimate is pretty significant. So at least for Apple, CAPM does not seem to predict the returns correctly, because we are going to get the returns over and above the predicted returns by the CAPM model. We are going to see that shortly. Let us repeat this exercise for the other two companies as well. Let us do it for, what do we have in this column? We have Spectra. So let us do the index linest combination again. Let me do that quickly again. So my known Y's are Spectra's excess returns this time. What are my known X's? Again, the market's excess returns. I want the constant and I want the stats. Close bracket for the linest function. For the alpha value, look in first row, second column, close bracket for the index function, hit enter. So we have the alpha value for Spectra. Now we can also find the standard error. Linest, known Y's, this is my Y range again, known X's. I could have used a $sign with the market success return so that I didn't have to select it again and again, but well, the standard error of the alpha is going to be in the second row and second column. So we have the standard error of the alpha for Spectra energy. Now we can find the Tstat. We can just, I guess, drag and drop this here. So the Tstat here is 1.5328, which is telling us that the alpha estimate for Spectra is not significant, and therefore we cannot reject our null that alpha is equal to 0. So for Spectra energy, CAPM seems to be predicting the returns, the excess returns, correctly. Now let us do it one more time for the last company that we have in our sample, HealthSpring. So let us use that index linest combination again. So these are the known Y's. This is our Y range, comma, this is our X range, market success returns again. We want the constant, we want the stats, close bracket for linest, and for the alpha value index function should look in the first row and the second column, close brackets. So we have our alpha estimate for HealthSpring. Let us see if this is significant or not. For that we need to find the standard error. And the standard error is going to be in row 2, column 2. So this is our standard error for the alpha estimate of HealthSpring. Let us find the Tstat. I could have dragged and dropped, but I'm going to demonstrate that one more time here. The estimated value of alpha minus the hypothesized value of alpha divided by the standard error. So this is our Tstat. Well, what do we see? We see that alpha for HealthSpring is also quite significant because the Tstat is exceeding 1.96. So we have an alpha estimate that is significant, at least at 5% level of significance and more. So what do we see? CAPM has predicted returns properly only for one of these three companies, and that was Spectra Energy, the middle one here, because here the Tstat gave us a value which indicated that alpha was not significant. For the other two companies, that is Apple and HealthSpring, we are earning some positive premium over and above the market premium, because what CAPM or the SML equation tells us, it tells us that the excess return on a security is related to its sensitivity with the market risk premium, and that is all. But it seems here by looking at the results that for Apple and for HealthSpring we are earning something over and above the market's risk premium, and that is captured by the alpha. So well, we have a reason to be happy that we have some positive alpha from Apple and from HealthSpring. But then this also means that the CAPM predicted returns may not be the correct estimates of returns for alpha and for HealthSpring. We could also find the beta, the standard error of beta, and the Tstat for beta by doing a similar exercise. So let me do it here quickly for you. Index, linest, and these are my known y's for Apple, known x's for Standard & Poor here. This is my excess market return. I want the constant, I want the stats, and I want the index function to look in first row, and the beta estimate or the slope estimate is going to be in the first column. So I'm going to tell index function to look in the first column and first row, close brackets, and hit enter, and we have the beta estimate here. Well, I'm going to do the beta estimate only for Apple, and you can do the rest as practice, maybe, but you won't have the Excel sheet to do this as practice. But well, you could, once you get the idea here, you can do it for any set of data, because I don't want this video to run too long, because then your attention is going to waver. Alright, let us quickly find the standard error and the Tstat, and then move on to other things. Index, linest. What we want here is the Y range of our data, which is excess returns on Apple, X range, excess returns on the market. We want the constant, we want the stats, close brackets. Where is going to be the standard error for our slope coefficient? This is going to be in the second row, first column. You can rewind the video to see that index function array again, or you could just search the internet to see that array. Well, the standard error would be reported to us in the second row and the first column of this array. So we provide these numbers to the index function, close brackets, and hit enter. So what do we have here? We have the standard error And the null hypothesis again is the same as before. The beta coefficient is 0, so we are going to just write here the estimated value of beta minus the hypothesized value of beta divided by the standard error. This will give us the Tstat, and what do we see? This is highly significant because this is way above 1.96. So the returns, the excess returns of Apple are responding to changes in the excess market returns significantly. Alright, for the other two companies I'm not going to do it here, but you know the general idea of how to do it. Let us now find the historical excess returns here, which is simply the average. Let us do it for Apple. Historically, on an average, Apple has given us how much return? Well, what do we see? About 2% here. And what would be the return, the excess return predicted by the CAPM model? Well, we know, look at this formula again here, this equation for the SML. The excess return on the security, in our case Apple, is going to be equal to the beta times the excess return on the market. So let us just implement that in that cell. Where is the beta for Apple? This is where the beta of Apple is, and we want to multiply this by the excess return on the market. I guess we need to first of all find the excess return on the market also. So let us postpone this for some time and find out the historical returns for all companies and the market here. So excess return on the market is this value here, minus 0.0079. Well, not too good. Now we can find out the CAPM's predicted return for Apple. This is the beta for Apple, and we can multiply this by the excess return from the market and hit enter. And what do we see? Minus 0.0094. Well, this is different from the historical estimate of excess returns. We could have done this for the other two companies as well, but you have gotten, I believe, the idea of how to do it. What I want to do is to make some more comments before we close this video, because it's already getting too long, 20 minutes and more. What we see from our results here, at least from Apple, is that there is a difference between the historical excess returns and the excess returns as predicted by the CAPM. Now, numerically speaking, the difference is not much, but it changes the whole scenario because historical returns are all positive and the CAPM prediction is negative. What could be the possible cause of the average historical excess returns to be more than the predicted excess returns? Well, that is where the alpha comes into the picture, which is simply the return that a security earns over and above what it was expected to earn. Now we know from before that a positive alpha makes us happy. In this demonstration, we have not made any security analysis to deliberately choose the positive alpha securities. So what we are seeing here for Apple is probably either pure chance or a problem with using estimated regression parameters. Pharma and French in their 1993 paper estimated the CAPM using over 30 years of monthly data. And what they noted was that betas change over time. If we do not make an allowance in our analysis for beta to change with time, then what is going to happen? This is going to cause an upward bias in the alpha estimates because the return is changing. We are not allowing one component, that is the beta estimate, to change. So the only component that is left to change is alpha. So what Pharma and French found was that this would cause an upward bias in the alpha estimates. So in our case, in this demonstration also, it could be just that. We do not know. What this demonstration also indicates is that portfolio managers are going to have a problem, and they do have a real problem, and that is that there is never a clear answer about which estimates of expected returns to use. We have already seen varying numbers for the historical and CAPM results. There are other methods also to arrive at expected return estimates apart from these. For example, if time permits, in a future video we are also going to look at the Black-Litman's model, which incorporates investors' views, and that would change the whole scenario about expected returns. This would complicate the decision maker's choice. In a world where many people suffer from a lack of choice, we are struggling with the exact opposite, aren't we? This is all I wanted to talk to you in this video. Actually, I wanted to also plot the security market line for you, but I guess I'm pretty much over time, 25 minutes and running. So I'm going to end this video here. See you later.